The role of monetary and financial sector policy in overall economic management in any matured economy has been gaining importance and attention. In the recent period, the issues related to money, banking, and financial markets have assumed the center stage with contemporary importance. In the banking and financial sectors, there are many concurrent issues which are widely flagged for debate and deliberations. In this backdrop, the Department of Economics had organized a national level symposium on money, banking, and finance last year.
Following the success, the department is delighted to organize and welcome all to the second national level symposium on money, banking, and finance.
Now, we request the dignitaries to light the Kuttu Vilakku and mark the beginning of the ceremony.
Respected Padma Vibhushan, Guru for many eminent economists in India, Dr. C. Rangarajan, Chief Guest for the occasion, respected Vice Chancellor, Professor Gurmeet Singh, respected Dean, School of Management, Professor Rao, my dear colleague, Dr. Lujom, distinguished guest of the dais, Director Studies, Director Culture, Deans, HODs, professors, my other teaching and non-teaching colleagues, our distinguished paper presenters, chairs for the symposium, participants, the scholars, students. Good morning to all of you. First, I wish to welcome our chief guest for today's event, and this is a matter of great honor for the School of Management in general and Department of Economics in particular, having person of his stature, maybe first time, the most distinguished guest for the School of Management. Sir is here. And of course, Sir doesn't require any introduction. As all of you know, Sir is one of the tallest economists of the country who hard worked in academics and who also extensively worked in all aspects of economic policy in India. Hardly there is a area in economic policy where his contribution is not there. Now, beginning with academics, he worked in the prestigious Indian Institute of Management, Ahmedabad, for quite a long time, more than a decade. He was a very popular teacher that I heard from some of his students who are now retired professors of IIMs. He also taught at Wharton School of Management, Pennsylvania University, Stern Business School, New York University, and he has been visiting faculty in many of these universities in America. So he has tremendous contribution to academics. He has wrote many books. His book of 1971, Principles of Macroeconomics, is still taught in many IIMs today for macroeconomics course. And of course, numerous publications in terms of books, research papers are there. All of you know about it. Now, in terms of his contribution to economic policy, Sir worked roughly 1.5 decades in the Reserve Bank of India, roughly 9 years as Deputy Governor, 5 years as Governor, and during this time, his contribution to economic policy in India is phenomenal. So I'll start with monetary policy, where he had laid the foundation of modern framework monetary policy, being part of Chakraborty Committee, the famous Chakraborty Committee, and then implemented the monetary targeting framework with feedback 1985 onwards, which Reserve Bank was following. So not only through his research, through his speeches all over India, if I going back to 1980s, 1990s, he made monetary policy popular in India. Any university, any institution he went, he talked about monetary policy. All the researchers, students became familiar with such a complex subject. Then, during with the initiation of the reforms, as our Vice Chancellor was informing, he was one of the very prominent team members of Narsingh Rao, Dr. Manmohan Singh team. He was instrumental in introducing reforms in almost all areas. After monetary policy, balance of payment, external sector, he chaired a committee on balance of payment, who basically laid the roadmap for reforms in the external sector, including exchange rate management. Coming to fiscal policy, he was chairman of 12th Finance Commission, 2005. This committee's report was effective from 2000, implemented during 2005 to 2010. All the students of economics and commerce management, we are aware, prior to 2005, the condition of state finances in most of the states in India was precarious. Many states were defaulting. And he basically introduced reforms in terms of adoption of fiscal discipline and consolidation through incentivizing the transfers from center. And that basically brought a sea change in the finances of most of the state governments. It will go on, we can keep on counting. Then he was, when he was the chairman of Prime Minister's Economic Advisory Council, when Dr. Manmohan Singh was Prime Minister for almost a decade. In all areas of economic policy, he had his footprints. So as an eminent academician, all of us know him. I was very fortunate, I was privileged to assist her for 4 years. And during this time, I have some experience which I need to tell you, because this will not be available in the public domain. So obviously, when somebody becomes this eminence, that requires lots of sincerity, hard working. I have witnessed it. For sir, work is worship. He doesn't know anything other than work. When he was governor of Andhra Pradesh, I was assisting him that time. And all of us know what is the lifestyle of the governors, political governors, the state governors. But sir's schedule will be 9 o'clock, sharp, he will come to office. Up to 1 o'clock, he will be in the office, 1 to 2, lunch, 2 to 5, 6, always in office. Other than, some meetings are there, other than that, he will be reading something. The moment IMF economic outlook is out, the moment RBI annual report is out, or any publication is out, immediately he wants it on his table. If he is not seeing on his table immediately, he becomes restless. So he will basically push all of us, get the publication at the earliest possible. And we are at that time, young people, we are although enjoying work, but sometimes we went break. We didn't have Saturday, Sunday, no breaks. Sir works 7 days, 9 to 6. And once Sir's granddaughter was visiting, his family, son's family was visiting Hyderabad, we were expecting, okay, sir, granddaughter is there today, at least sir will not come to the office. Same 9 o'clock, sir is in office. Then thought, okay, after lunch, maybe he'll take rest and play with the granddaughter. Again, 2 o'clock, sir is back in office. Now, of course, there are many people who are very competent, they are very intelligent, but somebody who is intelligent, competent, efficient, and good human being, that combination is very rare. I'll share one example. When I was there, I was doing my PhD, and sir is just a very good library in his office itself. So sometimes when I was taking advice from sir, sir will tell, okay, you refer this book for this chapter, this book, this issue. So once I was trying to find a book from his library, that library will be, governor's office is a big office. So in front will be library and sir's chair, table will be there, desk will be there. So he saw me struggling picking up the book. Then he came from the chair. See, I was just assistant. Sir is the governor, see the comparison. He walked out from his table. Okay, still I can understand somebody pointed out, this is the book. He didn't do that. Sir bowed down, picked up the book from the lower floor and gave to me. So that shows his, great human being with a, humble, modest, and such a godly person. So if there is somebody, some God can be possible on the earth, in my view, in my experience, it is Sir who is God. So we are very fortunate, sir, to have you here. And our symposium, I'm going to talk a little after about that. We are very encouraged, blessed with your kind presence. Now, we welcome you, sir, for this symposium, and thank you for your request. Thanks, Yulgi. Our Honorable Vice Chancellor, he is a renowned academic administrator. He is a scientist of international repute, pertaining to the area of corrosion science and smart material. and he has a long stint of teaching experience in Delhi University. He visited many international universities related to his work. I think these places include academic institutions in Germany, Italy, Australia, Singapore, Korea, Thailand. And he served as a chair professor at Lungwana University, Taipei. He is a member of very distinguished Royal Society of Chemistry, London, and he is a fellow of SEST and Electronic Society of India. And it is a matter of pride for the entire university community. Recently, he was bestowed with NIGIS Lifetime Achievement Award for 2019, which is a very, very respectable and distinguished award. And he has been always encouraging us for various academic endeavor. Sir, we welcome you, and with your kind presence, we are very encouraged to conduct this symposium. And our Dean School of Management, Professor Rao, he is like a father-like figure for all the professors and students in the School of Management. We welcome you, sir, for this event and for your kind presence. And we have many distinguished senior administrators and professors of the university, Director Studies, Professor Balkrishnan, Director Culture, Professor Jain, all the HODs, deans, faculty members. We welcome you all. And our most important guest, the chairpersons and paper presenters of various sessions, Professor Satyanand. Dr. Satyanand is a senior economist, director in the Reserve Bank of India. Professor Prabhakar is a senior professor in Institute of Economic Growth, New Delhi. Dr. Harendra is director, Reserve Bank of India. Dr. Santosh Sahu and Dr. J.V. Singh from director, Reserve Bank of India. Dr. Rath is a general manager of SEBI. Professor Mahakud, professor of IIT Kharagpur, and all. We welcome all of you, all the participants, we welcome, and all the scholars, students, and our non-teaching colleagues who are present here to encourage us, we welcome you all. So before I end, I understand you'll be very keen to listen to sir. I'll just take 2 minutes to talk about this symposium. The importance of money and banking, finance in the economy can never be, overestimated. Particularly, the banking and finance help in mobilization of saving and augmenting capital formation and supports the economic performance in the long run. Similarly, in the short run, for macroeconomic management, the banking channel, financial sector channel works as an important conduit for monetary policy and supports in moderating the economic fluctuations. But financial sector is like atomic energy. If you are using it properly, it is very useful. It has phenomenal service for the economy as a whole. But if it is uncontrolled, it can be disastrous. So when there is a financial sector crisis, as all of us may be aware, with the global financial crisis, recent slowdown, then it can harm the economy like anything. So that's how there is a need for understanding the role of finance, the role of regulation, and there is a need for constant and continuous research on issues related to banking and finance. Keeping that in mind, in our Department of Economics, last year we initiated this symposium where we provide a platform for the regulators coming from RBI, SEBI, and the researchers from academics to have an interface. Because in academics we have time for conducting research, but we are not aware about the practical nitty-gritties. In regulators or the bankers which we have, they know the practical aspect, but they do all the firefighting. They don't have time for conducting research. So this is a platform where we try to bring these two sets of people and build some common ground, learning from each other, and develop the agenda for research in the area related to money, banking, and finance. And of course, we don't confine into a small room. We try to accommodate as many scholars, students, and faculty members are interested to benefit from this. And of course, we don't charge anything. It is basically a free service to all the students and scholars. And with that thing, last year we started that, and we had a very good, successful experience with Dr. Reddy SARS, who basically treats himself as SARS student and good friend. He inaugurated the first edition, and we are very fortunate today to have SAR in the second edition, along with all the eminent researchers in area of money banking finance. May I request our Honorable Vice Chancellor to honor our chief guest.
Now we'd like to invite the Professor K. Chandrasekhar Rao, our Dean School of Management, to deliver the felicitation address. Sir, please.
So it gives me great pleasure in associating with this symposium on money, banking and finance, especially when a stalwart economist is giving his inaugural address. Sir, every citizen of this country really appreciate all your policy prescriptions to the government of India in making us to cross over or breach over the Hindu rate of growth in the last 2 decades. Today, we are very happy to see you here and eagerly waiting to listen to your monetary policy prescriptions, especially when the government of India and the Indian economy is dancing to the tunes of the global recession or recessionary trends. So I think I wish to be more serious to listen to you rather than speaking on this occasion. I think my colleagues will join me in really putting our thanks because the university and as well as the School of Management is really honored by your visit to this campus. Thank you, sir.
Thank you, sir. Now, we would like to request our Honorable Vice Chancellor, Professor Gurmeet Singh, to deliver the presidential letter.
Good morning, friends. Our very respected Professor C. Rangarajan, Professor Chandrasekhar Rao, Dean of the Faculty, Dr. Amresh, and all the senior deans and my faculty members sitting here. And above all, I'm very pleased to see some of the young students, young researchers who are here. And I think they're the luckiest few who are getting a chance to listen to a stalwart like Professor Rangarajan. We are, sir, indeed honored and blessed by your presence here. It's one of the rarest of the rare occasions when you have been here and to bless our youngsters. I'm sure they'll be able to interact with you on many other issues related to their own work. Dr. Amresh has already said a lot. I will not take much of your time, but I'll say that Dr. Rangarajan is a rare blend of excellence in everything. When I say everything, you name a quality which is needed, he has it. To begin with, he's been an excellent teacher, everybody says, and most of the wonderful economists who are there in our country have been trained by him. I think that's the best description that I can give. And then subsequently, as a wonderful researcher who came to the ground level and thought about Indian poverty and how best to get out of that. If history will be written, if you remember the early 90s, that history will put his name in the most prominent letters, that he was the person who brought it out, of course, with the team, India out of an absolute doldrums. And now, if we are what we are, we take great pride in saying, why should I go to US? We have everything here. We are in that state of affairs because of the policies, firm policies on which Dr. Rangarajan laid our system early in 91. At that time, there were criticism that we are opening, we are doing this, we are moving into a very dangerous path, we are treading a very fine line, but then they were very firm. Banks had a lot of problems at one point of time, and our banking sector never failed. It was because of the policies that he laid. Those economists who are doing research, they will have the occasion to go through, and you will find what a rich contribution he made. Then moving on further, he's been a great administrator. Handling Reserve Bank of India is in itself, I think, the best that one can do. He's done it with absolute great credit. And then we move on further. Above all, All qualities are there. He's been a wonderful Indian. That's what is required. He's been a wonderful human being. He's been an excellent family man. One can be a very good academic, you'll find they will neglect the family. One would be a wonderful family man, they'll neglect academics. So his is a rare blend of all wonderful qualities that you can look into. And you have seen, I've been talking to my young students about time management, that how important it is. If one has to draw a lesson out of somebody's leaves, it is Professor Rangarajan. Year after year, decades after decade, the schedule that is there, he's still following. And he's a young man, let me tell you, you don't realize. I will leave it to you as an exercise. And if anybody guesses, I'll give him some good reward. So he's a wonderful young person, and that's a lesson we all need to draw out of his presence here. We are indeed very much blessed, sir. And whenever discussing, I said, sir, an economist is one, you know, that I always put things in a lighter way, and we were having some serious discussion about various economists. I said an economist is one who gets richer by telling you why you are poor. And he not only enjoyed, he said it is even truer for those economists who are settled abroad, because they are making much more money by telling us why we are poor. And the worst part, which he had the guts to say, I have not heard from any other economist, he said, you know, they are there in their own palaces and they are talking about Indian poverty, sitting there. What they need to do is to study things at ground level. Professor Rangarajan is one of those who has studied everything at the ground level, and then he has written about it. And I think it is this kind of a study which enabled us to come out of our darker days. And now, even if global recession is there, we are confident that our policies have been laid on such firm footing that we will come out of it. You talk to anybody, we are all very sure it's a temporary phase. Everybody says it's a temporary phase. Don't worry, we'll come out of it. We'll come out of it. Our banking has been very strong. All this is there because of the firm footing on which Indian economics was placed. And he's trained a lot of economists. They are fanned all over. So we are always very confident that we are in the safest hands because of the rich contribution that Professor Rangarajan has made to Indian economy. We are indeed grateful, sir, and I extend my warm welcome to him with a hope that in future too, he will continue to bless our youngsters by visiting this university again and again. Thank you very much. God bless all of you.
We now request our Honorable Chief Guest, Padma Vibhushan Dr. C. Rangarajan, to address the gathering and to give his valuable insights on money, banking and finance. Sir, please.
Professor Gurmeet Singh, Professor Rao, Professor Samatharaya, distinguished faculty, economists, and participants in today's symposium. It gives me indeed very great pleasure to be with you all this morning and in this beautiful campus of the University of Pondicherry. This university has steadily climbed from one level to another level. I'm very glad that maintaining the quality of education, higher education at a high level, has been one of the major goals of this university. In fact, while there has been a significant quantitative expansion of higher education in this country, the regret is that the average level of quality has come down. There is no doubt at all that some of our best students are really the best in the world. There is no doubt about it. But it is the average that has caused concern. And that is why we need institutions like the University of Pondicherry. In the world of today, competition in any field is competition in knowledge. And that is why we need institutions of excellence like the University of Pondicherry. I would like to congratulate Dr. Gurmeet Singh and his colleagues for the efforts that they are putting in order to maintain this university as one of the best in this country. I'm also grateful to him, as well as to Professor Rao and Professor Samantaraya for the kind words that they have said about me. I'm deeply conscious of the tributes that they have paid, and I do hope I reserve them. This morning, while kick-starting this symposium on money, finance, I will take the opportunity to say a few words about the current status of the Indian banking system. And if time permitting, later on I will say a few words on monetary policy. But the main focus of my lecture this morning will be on the Indian banking system. The financial sector, as Samantaraya mentioned, plays an important role in the economy. It facilitates economic growth by institutionalizing savings and investment. Financial institutions, markets, and instruments constitute the financial sector of a country. And they play the important role of transferring resources from the savers to the net borrowers. It is this process of intermediation which makes the financial sector critically important in the country. In the kind of transformation that is occurring, there are four aspects. First, there is a liability asset transformation. Banks, for example, receive deposits, which is a liability to the banks, convert them into assets, which are loans. Second, there is a size transformation. They receive deposits of small size, small quantity, but then convert them into large loans. Therefore, there is a size transformation. And there is a maturity transformation. They receive deposits of various maturities, 1 year, even less than 1 year, 2 years, and 3 years, and convert them into loans of longer maturities. And finally, there is what is called the risk transformation. In fact, in the absence of the financial intermediation, what you will have is a system in which there will be a direct link between the saver and the net borrower. In that case, the risk per unit of the currency will be higher. It is this risk which has been brought down as a result of intermediation. Therefore, the financial system undertakes the task of pooling resources, transferring resources across time and space, and managing risks and clearing payments. The advantage to the society depends upon how efficiently this process of intermediation is done. And how do you judge the efficiency with which the banking system functions, to which I shall come a little later. But the basic fact is the intermediation brings benefit to the system by being efficient, which essentially means reducing the what you might call the minimum cost in terms of transformation, and also ensuring financial stability. It is this which has become extremely important in recent times. Financial intermediation is understood, but the financial intermediation has to be done in a manner in which the transformation cost is minimal, but at the same time, the financial stability is maintained. The last 50 years, that is beginning 1969, had seen two revolutions in the Indian banking system. 1969 was the year in which the major private banks were nationalized. In 91-92, the introduction of the banking reforms once again changed the banking system. The motivation for nationalization of the major private banks in 1969 is still a matter of dispute. Whether the intention was mainly political or economic. But that controversy will go on. In fact, the Reserve Bank of India in 1969 was only informed and not consulted. But the economic objective of nationalization was very clear. It was felt at that time that the banking system was urban-centric, and the banking system was, in terms of in terms of its operations, focused more on large loans and industry particularly. The objective of nationalization in 1969 was to change the both, shift the focus towards the rural areas, and also to ensure that the flow of credit happens even in relation to vulnerable sectors of the society. The transformation was very clear. The number of rural branches in 1969 was 1,300 and something. By 1983, the number of rural branches in India was 30,000 odd. And therefore, the population per branch came down very drastically. In order to provide credit for the vulnerable sections, many changes were introduced. The concept of priority sector took shape. And the institutional arrangements, just as the lead bank scheme, were introduced. And therefore, in a sense, by 1983, one could say that the objective of nationalization, in terms of widening the scope of the banking system and extending it into rural areas and to cater to the needs of the vulnerable sections, has been achieved. But there is a problem. The quantitative expansion and the focus on vulnerable sections and the provision of credit at low rates of interest had also an impact upon the efficiency of the banking system. When in 1991, we had to deal with a very severe problem, we found out that the banking systems profitability was low, the net worth of many banks was negative, and therefore something needed to be done in order to bring about a transformation in the banking system. As you all know, the working of the banking system is judged by two criteria. One is operational efficiency, and the other is allocative efficiency. Allocative efficiency essentially means how the total resources available to the banking system is distributed among people. The 1969 measure was essentially focused on allocative efficiency. And also, the allocative efficiency was judged at that time not by market forces but by some social factors. But in this particular process, the operative efficiency suffered and it had to be rectified. Please remember, without operational efficiency, the allocative efficiency also cannot continue forever. If the banks are not profitable, if the banks are not efficient, they would also not be able to extend their operations into the rural areas, or extend operations for the vulnerable sections. Therefore, operative efficiency becomes important. And that is what happened in 1991-92. I will not repeat to this audience what we did in 91-92 in terms of the banking reforms. See, by the time of 1991, the cash reserve ratio, CRR as we call it, and statutory liquidity ratio, SLR, had risen to very high heights. I don't know whether you recall, SLR was 38.5% in 1991, and this cash reserve ratio was almost 15%. And there was also an incremental cash reserve ratio at that time. Therefore, on incremental deposits, more than 60% of the resources were preempted either in the form of CRR or SLR. And there was very little available for lending by the commercial banks. The important thing is the provision of credit to the priority sector and other areas were also at a rate of interest is well below market rate of interest, and therefore it affected the profitability also. So CRR and SLR were brought down very substantially during that period. In a matter of 5 years, we brought down the SLR from 38.5% to 25%. So, and then of course, we allowed new private banks to be set up. We also modified the Nationalization Act to enable the holding of the government to come down from 100% to 51%. And the most important thing was to introduce what we call the prudential norms and capital adequacy ratio, income recognition, and so on and so forth. It was not an easy task because when banks, as a result of the new prudential norms, had to show losses on their balance sheet, it was a very difficult thing for them to digest. They have been telling their clients to have a good and strong balance sheets, and they find themselves ultimately to a balance sheet which was not very sound. So, as they say, physician, heal thyself. So that is the kind of a situation that was there. But slowly and steadily, the situation improved, and by somewhere around 2000, by the end of that decade and the beginning, the non-performing assets all came down to a very low figure. It was almost 2.5%. Please remember also, the word non-performing asset you will not find in the literature prior to 1991. The concept was not there. It was only the income recognition norms that were introduced in 91-92 clearly created the situation of call whether a particular asset is performing or not performing. So today, if we talk about non-performing assets ratio very freely, please remember that nothing like this was being talked about or discussed prior to 1991. So as I said, by somewhere around 2007, it was about 2.5%, the gross non-performing assets ratio. As you know, the gross performing assets ratio is a ratio. The numerator is the gross performing loans, and the denominator is the total loans. So out of the total loans, how much is non-performing? Very quickly, in March 2018, the non-performing assets ratio was 10.3 trillion rupees, and it was 11.2% of the total advances. And in the case of public sector banks, it was 8.9 trillion rupees. Trillion is really lakh crore, so 8.9 lakh crore, and the non-performing assets ratio was 14.6%. These are very high numbers. What happened? Between 2007, when it was 2.5%, and 2008, March 2018, it has become this. It did come down in March 2019, and we do now have figures released by the Reserve Bank of India last week or so on September 2019 as well. So as of March 2019, it came down to 9.3% from 11.2%, and as far as the public sector banks was concerned, it is 12.6%, coming down from 14.6%. As of September 2019, the numbers remain the same. So there is some improvement, but it is still very high. It is in fact one of the highest in the world. I mean, there are 4 other countries which are bordering this level, or some of them slightly higher than this. These are countries like Russia and so on. So one more information. Large borrowers account for 51% of the total loans and account for 79% of the non-performing loans, because that clearly indicates that the biggest problem has been the large loans, because obviously when a large loan goes bad, then it drags down the whole thing. So the question really to ask ourselves this morning is, how did this happen? And what can be done? So the part of the reason lies in the fact of the credit boom, which started somewhere around 2003-4. Between 2003-4 and 2007-8, that is 4 years, the total loans of the banking system increased by 3 times. In the next 4 years, the total loans increased by 2.5 times. And the following 4 years, it increased by 1.5 times. Therefore, there was a phenomenal growth in credit. So the question arises, is this a problem or not? What happens in good times is everything looks rosy. Please remember, this was a period in which the Indian economy was growing at 9% per annum. So everybody thought we have entered a new era. We are going to have a 9% rate of growth for a decade and more. So every project looks attractive. Can't blame the bankers totally, but every project looks attractive. For example, you look at the way in which the bankers give loans, let's say for roads or heavy vehicles or something like that, whatever. They first calculate what the traffic growth will be. How do you calculate the traffic growth? You look at what the rate of growth of the economy would be. So if you assume the rate of the growth of the economy is 9% per annum, then the traffic growth increases at that particular rate, then you need so many vehicles, and therefore this project is worthwhile. So there's an old saying, I don't know whether you remember or not, that bad loans are sown in good times because everything looks attractive. And that's what happened. Fairly large loans were given. And it is true that between 2004 and 2008, the monetary policy was tightened. I mean, it is not as if the monetary policy was loose. The monetary policy was tightened. In spite of that, there was fairly large credit growth. And in history, it is very clear. In almost all countries, credit booms are always followed by stress in the banking system. What happens? Projects that were viable at one time cease to be viable once the rate of growth falls. And the cash flows become less than what they had been anticipated to be. So this is one of the most, the problem erupted like this. I have written somewhere that what we are experiencing in India today is our 2008-9 crisis. What happened in the US in 2008-9? The decade previous to 2008-9 is described as great moderation, in which the price level was low, the many other parameters were steady, and the economy had the best rate of growth. And therefore, the loans expanded, and more especially the subprime loans, as they called it. And why subprime loans? The subprime loans in the United States were all for housing. And what is happening in a period, as it happened in India too, in a credit boom, home prices go up. And lending to homes, against a mortgage of homes, is always considered to be a safe one because there is an asset whose value is keeping on rising. Therefore, always people thought it is less risky to have mortgage loans. But suddenly in the United States, what happened? The housing prices fell. Then all these loans became once again difficult. There were many other problems. I'm not going into it, the derivatives and so on and so forth. But the problem is really, all credit booms, this is what the financial history shows, is always followed by stress in the banking system. Of course, there are also other problems. While in the real sector, in the real economy, there was a boom, but there are also other problems like environmental concerns, acquisition of land became difficult. So many projects that were initiated were also coming to a difficult situation because of problems relating to land acquisition, environmental concerns, and so on. In fact, I will come to you a little later. Even the court judgments played some havoc with some of the sectors of the economy. So, of course, when we look at the ratio of the NPA ratio, we must also understand that the sudden tightening of the quality also creates a new situation. What happened is 2015-16, right? That is the asset quality review, which was undertaken. And as a consequence, within 1 year, the NPA ratio went up to 9.3% from 5% because of a tighter definition and a tighter overseeing of what the NPAs are. Then further analysis will show that I had analyzed it, there were 5 sectors in which there was a fairly large extension of loans: mining, iron and steel, textiles, infrastructure, which includes roads and telecom and power and aviation. You will look that all of these had problems of their own. For example, let me also say, the public sector banks provided 80% of the advances to all these sectors that I mentioned. So naturally, when these 5 sectors suffered, the public sector banks suffered more than the private sector banks. Why was the exposure so high? Was there a political compulsion? Were banks nudged to expand? Or were banks being accused of being lazy bankers? I don't know. The term lazy banking also originated from Reserve Bank. And sometimes they said that, what kind of a banker is this? You receive the deposits, put it in government securities or something, and live comfortably. Now that is what is called lazy banking. Therefore, lazy banking was being where they were afraid of being called lazy bankers. In fact, there was, at that time, there was a push from every side. I mean, Greenspan called it, in the United States, irrational exuberance. Now, there must be somewhat of irrational exuberance which arises whenever the economy booms and whenever we think that the economy will grow at 9%. Yes, that happens. Therefore, that some amount of irrationality enters into the picture despite ourselves, because we see the economy growing. In fact, if you had asked anybody in 2004, 5 or 5, 6, yes, we have entered a new era as far as India is concerned. We are all going to grow at 9%. So that is, I don't know what these are, but certainly there was perhaps a nudge. You look at power sector. Power sector is basically owned by the state sector in some way. And they were nudged to provide more loans to all these institutions. And they are in a bad shape. For example, in the case of mining and all that, or even telecom, there were court judgments which nearly crippled these industries. So there is also this thing that people say that the commercial banks were not experts in providing credit to long-term loans, to industrial projects. We had earlier specialized institutions like IDBI and others, which had better experience in assessing large projects, or what we call infrastructure projects. I don't know, I mean, those went out of business somewhere around 2000. But 14 years or 15 years is long enough for banks to acquire the expertise or qualities. But again, that is one thing that is being mentioned. Then what happens as a result of higher NPAs? You need to provide higher provisioning, and higher provisioning leads once again to lower profitability. So it is also not true that private sector banks have done better than public sector banks. That's also not totally clear. Some of them have done well. The total of private sector banks is less than the total of the public sector banks. But there are some private sector banks and some foreign banks whose non-performing assets ratio is also the same as that of the public sector, some of these public sector banks. Because of, you see, that is what is called consortium, in which large number of banks join together and provide credit. So if many of these large loans were consortium loans, therefore it affected not only one set of banks, but also another set, all other banks which are part of that consortium. Now, very quickly I will come to the end of my story. What do we do with the situation? There are two sets of issues. One is, how do you resolve the issue? Namely that there is a high non-performing assets ratio. There is a situation in which the banks are holding in their balance sheet large non-performing loans, and therefore what should be done in order to get rid of them. The second set of issues is what should be done in order to prevent something happening like this. So these are two different sets of issues. In fact, I would like the researchers to look at how much of the non-performing loans outstanding today are a consequence of factors external to the banking system, the slowdown in growth, or other factors. How much of it is due to the external factors beyond the control of the banks? ex post you cannot judge the banks. You must judge the banks in terms of the information they had at the time they gave the loan. Therefore, you must really see that if the external factors have contributed, then we should be able to separate it. The bad loans can arise because of three sets of reasons. One, factors beyond the control of the banks. Second, bad judgment. That is, there is nothing malafide about it, but they have gone wrong. After all, that is why we call it risky. If all loans are perfect, then that is not banking. I mean, there will be some loans which will go bad. And the third is purely malafide. I mean, I think the banks giving loans, knowing well deliberately that it is not a good loan to give. So I think, I do not know whether we will have the information to do it, but I think some analysis must be done in order to be able to see what causes this thing. Now let me not take much of your time on resolution. The resolution has been one of the important things in the mind of the regulator, because the Reserve Bank of India, they started as early as 2001 in terms of what they call debt restructuring and so on. And there have been many efforts on the part of the Reserve Bank of India in terms of what called the rules which will govern one-time settlement and so on. And they also try to, more recently, the prompt corrective action in which banks which are failing to do their duty are brought under special supervision and are not allowed to lend more unless they come out of it. Therefore, a lot can be said about the resolution measures that have been taken. I think in this particular process, the IBC, as we call it, the Insolvency and Bankruptcy Code, is a very important step, and it does make the promoters of companies which have gone bad a little more fearful of the lenders. Otherwise, they also threw up their hands and said, well, it had gone wrong and nothing. They seem to be, as they say, that may be bad loans, but there are never bad borrowers because they always get away with it. So I will not go into it. There's a lot to be said in that area of what should be done to resolve the problem that we have in hand. Some people have suggested the idea of a bad bank. I mean, I think the very name of it stinks somewhat. I mean, I think this is not what you want to set up. But this is essentially an asset reconstruction company, which will take away the loans, the bad loans from the banks, and they have the specialization and the expertise to be able to get the repayments back. We need to try all of that. And finally, I want to come very briefly, I've taken a lot of your time, and finally to see what are the lessons that we can learn from this episode. There are lessons for the regulator, there are lessons for the government, and there are lessons for the banking system. As far as the regulator is concerned, an important thing is the monitoring of what is called the macroprudential indicators. The macroprudential indicator essentially relates to the rate of growth in credit, the rate of growth to specific industries, and the rate of growth to specific groups. All of these are macroprudential indicators. And it really needs to be monitored. and also made public. After all, let us put it this way. Even in the best of the period that we had, between, let us say, 2005-6 to 2007-8, or say 8-9, not 8-9, but 9-10-11, we had a real rate of growth of 9%. Add another 4% for price increases. The nominal rate of growth of the GDP was 13% or 14%. But the average rate of growth of credit was 18 or 20% during that period. Now, this is something that one should have really looked at. Therefore, a more watchful requirement is required on the macroprudential indicators. The other is an important problem, namely that the measures to be taken on regulation. Because after the 2008-9 crisis in the United States and elsewhere, the question that arose was, if the financial system goes bad, it creates a lot of problems for the economy. What do we do? There are two options. Paul Krugman suggested, make banking boring. It's a famous statement. What does that mean? That means there are no derivatives, don't give any complicated loans, essentially keep the deposits, put them in government paper, give them a loan only when you are completely satisfied or something. This is basically reverting back to a system when there is no intermediation at all. So that is, banking is boring. I don't know whether you remember that in the British days, they used to describe the bankers as what? I don't know, 363 or something. What does it mean is, you get deposit at 3%, lend at 6%, and go and play tennis at 3 p.m. Now, this is making banking boring. Now, you don't do anything. The other is, tighten the regulation. These fellows are bad, therefore you tighten the regulation. Now, will tightening the regulation solve the problem? Some of you must have looked at that in Europe, they have estimated the loss in GDP because of the tightening of the regulation. For example, capital adequacy ratio from 8% to 10%. You make it 12, 15, 20. Then what happens? Then you will lend less. But basically there is the problem of the loss in output. Therefore, regulation, whether you keep on tightening, whether that will solve the problem. Sometimes they say that it does not, or the problem. So as somebody said, an apple a day keeps the doctor away. A regulation a day keeps the regulator busy and gay. Now, what is it? I mean, you can tighten regulations, but how far will you go and tighten regulations? Actually, what we really need in terms of regulation is, I understand the complexity of the problem. It is not as if the regulator is genuinely happy to introduce regulation every day. But he is faced with a problem. The financial structure is becoming more complex. As they say, the policeman has to be one step ahead of the thief. Therefore, you have to do it. But at the same time, what we really need, this is my view, identify certain parameters which must be monitored very carefully. In the current situation, I certainly feel that monitoring the overall credit growth and the sector-specific high growth, then probably we would have not been in the same problem as we are now today. I will leave other things. Let me very quickly wind up. What are the lessons for the government? This goes to a very fundamental question. The government owns banks. Now, what is the relationship between the government and the banks that they own? The most important thing is, loans are business decisions. While the government, as the owner of the banks, can lay down the broad policy, interference in the decision of giving loans by the banks or the bank board should be avoided. I mean, interfering in specific loans. As I told you, this is a much broader issue. What is the relationship between the government and the public sector units? It applies not only to banks but also to other public sector units. It is always said that the government should maintain an arm's length from the board. I think that is an important issue that we have to decide, not only in relation to banks but also to other public sector units. Where the line is drawn, where the government should not go beyond that, is a very critically important thing. Of course, there are other things that one can talk about, namely that the capitalization, I have talked elsewhere, of the banks is all being done by issue of bonds. I have a feeling that if you do it partly in cash and partly in bonds, or partly or fully in cash, it would make a big difference as far as the banking system is concerned. And one larger issue still remains. The government have also to decide how much of the banking system should be under the public control. The old argument is what is very, very often referred to as the theory of commanding heights. The theory of commanding heights essentially means that the government must keep control over key centers. It's, I think, drawn from military strategy. But how much of the banking system should the government own? I think that's an issue that will have to be discussed. And finally, for the banks, I think banks need to understand whether there are regulators or not. They are finally responsible for the loans that they give. And if there is a lack of expertise in one area, they need to build that expertise. I think there are 2 or 3 things that they will have to do. One is improve the expertise in giving the loan, improve the expertise in monitoring the loan. And I think these are areas in which they will have to invest heavily in training and so on. The assurance systems like internal and external audits and credit rating also will have to improve. Ultimately, the strength of the banking system depends on good judgment. In my view, banking need not be either boring or adventurous. Bankers need not be either lazy or hasty. They must strike a balance, and that is where lies the answer. I will not take any more of your time. I wanted to say something about monetary policy, but I will reserve it to some other time. I have already taken most of your time. So that, I think, is where we stand in relation to the banking system. And in a sense, the foundation for a fairly efficient banking system was laid in 1991. But as you all know, that the systems need to be worked through. And I do have a feeling that we will come out of this. And one question that people ask us, which comes first? Whether we coming out of the slowdown or coming out of the NPA problem. I have written elsewhere that getting the banking institutions back to a situation in which where they are confident to lend is essential for reviving the economy. But you can also say reviving the economy will also help the banks to come out of the situation in which they are there. Because once the economy begins to revive, more credit can be given. And once the economy begins to revive, some of the repayments also will come on the loans. Therefore, it's a chicken and egg problem. But I think we need to see simultaneously, we move on one step ahead in terms of improving the financial situation and reducing the non-performing assets, and at the same time work towards faster recovery from the slowdown. That lies the answer. Thank you very much.
We are very grateful to you. We wish that we have many more of such opportunities. I also would like to thank Dr. Gurmeet Singh, Professor Gurmeet Singh, our Vice Chancellor. He has been always supportive of any programs that the department has conducted. He has been always present and supporting us, encouraging us. Sir, we are thankful for your presence. I also would like to thank Dr. Rao sir, the Dean School of Management, for his constant encouragement and support. Thank you for your presence, sir. I also thank Dr. Amresh. He has been the sole architect of this symposium. I really thank him I wish that we have many more of such a symposium. I would like to mention and acknowledge and thank the presence of Dr. Director Sir, Director Studies, Director Culture, and many more dignitaries. I am really thankful for all your presence, HODs, senior faculties from my sister department, from other departments, my colleagues. I'm really thankful for your presence and for your support. I would also like to thank the distinguished speakers from reputed institutions, from IIM, RBI, SEBI, for your presence here. I also would like to thank the participants, without whom I think the symposium would not be complete. The last, but not the least, I would like to acknowledge the help, the support that has been given by various departments, electric department, horticulture, engineering, the media, and yes, I thank all your support and for your kind presence at this Focus Gathering. I wish everyone have a good day, and also I wish everyone a very happy New Year. Thank you.